And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, my God. Are you nuts?
With your host, Phil Grande.
Bye.
Friday, the TV jibber jabbers on Friday were pointing out the crash, tech crash. But it wasn't a tech crash. You can't have a tech crash without having the institutions participate. They are the market. All the hedge funds, pension funds. I mean, you can't. It's like having a birthday party without a cake or presents or candles. So Friday's 1,121 point crash that was labeled, okay, as this tech crash made no sense, not at all. So I want to explain to you what happened, what it is, and also why is it we're now hitting all-time new highs and companies are dumping, they're selling their stock. What is it that they see that we don't see? But first, Friday. Friday was a reaction to that 300,000 job number. That's what it was all about. So the TV jibber jabbers turned around and say, 300,000 jobs, wow. What an economy, we're really strong. Why do we need to buy bonds, be defensive? I mean, we buy bonds because we're worried. We don't need to be worried. This is 300,000, what? Wow. Let's dump our bonds. And they did. And the TV jibber jabbers, that's when they started, wow, we're now entering a tech crash. Now, a couple things. The 300,000 jobs, those jobs really sucked. That's the funny thing. Jobs were terrible. They're all part-time jobs. Most all of them are part-time jobs. And they're lousy jobs, lousy paying jobs, no benefits. But this was the big deal. That's what started it. Now, when the selling started, and everybody was dumping the bonds, yields started to go up because nobody's buying. When you buy bonds, as you know, yields go down. Now, the problem was that when you don't have the institutions participating, they're sitting on the sidelines. I'm talking about the pension funds, I'm talking about the hedge funds, I'm talking about the mutual. They got all the money. They're not buying. So what happens is, in that case, computers have always been programmed to seek out, to identify when there's light volume. And then basically what happens when there's light volume, they identify the light volume. Think of it as a breaker switch gets tripped. And they start in this case, selling. And they step in, but they started to sell like crazy. And there was no institutional buyers. So the bond selling went wild, crushing tech stocks. But it wasn't a tech crash. Nobody understood that. Sunday night, I wrote to my gang members saying, look, be careful. This was not a tech crash. Don't go in there Monday morning and start selling everything. Be careful. And look, if this was a tech crash, why would the NASDAQ be positive all day? We're up about 254 points today. That wouldn't be happening. Now, again, we had that 300,000 jobs that kicked this thing off, got everybody crazy. So the AI bubble. I want to play you a cut. And before I play the cut, just remember what happened. Again, the next time you see this, and you know and you'll understand, and you won't panic. So you've got to have institutions participate to have a crash. They're the big guys. They have all the money. They have $18 trillion in which they use to buy and sell stocks. and they weren't selling, and they weren't buying, and they weren't participating. So Wall Street basically conned everybody. And they'll do this sometimes where the big boys on Wall Street want to buy stocks cheaper. And that's what they do. They'll come out with a story, they'll paint the tape, as we call it, to create a story. And so the market drops 1,000 points. They go right in and start buying. That's what I think happened. But it was also interesting, we're being told that we don't have an AI bubble. But in fact, this market, other than in 2000, the dot-com crash, this market's nuts. It's the most expensive in history. But they're saying there is no bubble. Play the cut.
This growth is because of expected earnings. It's not really a speculative bubble.
That's not true. That's another lie. That's another lie. So if that was the case, it's not a bubble, then why are companies like Google, they're going to issue another $80 billion in stocks. Now I don't maybe have, 80 billion in new shares. Are you kidding? SpaceX, why are they going public with an IPO? If everything's fine and this is no bubble, and everything's wonderful, and everything's in the valuations are cheap, then why would they do that? Now, the TV jibber jabbers, they keep telling us AI isn't a bubble because earnings justify everything. Play that again, about the earnings one.
This growth is because of expected earnings. It's not really a speculative bubble.
Well, that sounds good, right? When the TV jibber jabber's shooting his mouth off, right? But it's wrong. It's not the truth. It's just plain wrong, okay? Now, the growth, I should say, is not coming from earnings. It's coming from hype. No one knows how to create hype or stories than Wall Street. Remember, the institutions have the money. Remember, going all the way back to 2008, after that 54% crash and $8 trillion wiped out, remember Congress and the Fed got together and said, no more storytelling, boys, on Wall Street. We're going to print $18 trillion, and we're going to give it to the 6 of these institutions. They're going to fuel the market. They're going to buy the stocks. No more storytelling, just big storytelling, lies, and then it all blows up, and look how the people got hurt. Lost 54%, the market dropped 54%, people lost $8 trillion, no more. So it's the big institutions that you got to follow that money. And on Friday, they weren't dumping. And I sat there and I'm going, why do they call this a crash? But let's get back to the earnings. If AI earnings were so great and so strong, companies, as they said, like Google, wouldn't be issuing more stocks, SpaceX wouldn't be going public. So, and here's the real danger, what they're doing. When you bring a company public, like SpaceX, or you issue more shares of companies already public, you get what you call a lockup. So people inside the company, the CEOs and everybody in the companies, they get a lot of shares, but they're locked up for 3 to 6 months. What they're doing is they're going to unlock these shares, and it'll probably be this fall. It's going to be the biggest unlocking of shares to be sold. So when you watch SpaceX come out, follows 3 to 6 months, and then everybody who was locked up, there's $700 billion the insiders have that they can't sell. The day the IPO comes out, they got to hold on. It's the law. But 3 to 6 months, they can do what they want. And in 3 to 6 months, we're going to have the biggest wave of selling in history. in history. So if they're telling us there is no bubble and everything's wonderful, then why are they doing this? Because they know there's a bubble. They know earnings are a bunch of nonsense. So the real danger is for the small investor who's sitting in AI stocks right now. After SpaceX goes public, and after Google, introduces another 80 billion in shares, and 3 to 6 months later, when the lockups are no more, and people can sell, the insiders can sell their shares, you know the hit these AI stocks are going to take. So don't you play the clips again.
This growth is because of expected earnings. It's not really a speculative bubble.
That's the biggest speculative bubble we've ever had in history, or at least compete with the dot-com days. So that's what the problem is. And so every time we hear, like on Friday, the lie with the TV jibber jabber, just like we're here with this lie, there's no speculative bubble here. You got to follow the money. If you follow the institutional money, you learn how to follow the institutional money. There's a certain way to do it. Then you'll be fine, because that's who you have to follow. They always tell the truth. But I'm telling you right now, when that lockup is released and people start dumping, you're going to see a big difference in this market. You're going to see a lot of selling in this market. So watch for the SpaceX IPO and Google's issuance of new shares. Put it on your calendar, and then make sure you lighten up on your AI stocks within 3 to 6 months after they issue more shares or their IPO. So that's what happened on Friday. Friday was just a joke. That 300,000 jobs, I mean, it's just insane. And we're seeing, and they're telling us how, I mean, Wall Street's cheering all, Main Street on, and how everything's wonderful, and but Main Street's getting crushed. I mean, U.S. bankruptcies are soaring. Individual bankruptcies, small business bankruptcies, I think are up 67%. I went over some numbers with you last week on the delinquencies on autos and now houses. So in manufacturing is dead, is really dead. And inflation, is still with us. Our wages do not cover inflation. Every time you hear how they cover our inflation, a bunch of nonsense. So what do you do as a trader with all this crap going on? Simple, just make money. Take all that noise, put it on your head, and follow the institutional money. Now, if we know AI stocks will probably get hit hard, then know how to sell short as well as long. I mean, that's one of the biggest problems in trading. And this is the truth. 85% of retail investors lose money. And it's just like 401ks. What a lie that is. People are sold that 401ks, you get a return of 6% a year. You're lucky to get 3.5% because of the hidden fees. Where if you invest in the spiders, you will get year in, year out 10%, even more, because especially if you're short. So right now, we got a real problem with bankruptcies, business bankruptcies, personal bankruptcies. The government deficits are killing us. Nobody talks about this stuff. We got the deficits, think about it. It's 18 billion a day, 18 billion a day. And the government is spending, I think, 19 billion a day. They collect 14 billion a day, and there it is, deficits 5 billion. I'm sorry, yeah, 5 billion a day. Are you kidding me? I mean, negative, the deficit between what they spend, what they bring in tax, we're in the hole. So, but as a trader, if you just stay away from fundamentals, don't buy stocks on fundamentals. That's the worst thing you can do. If you just buy stocks on, okay, which stock is the institutional money buying? Which stocks? That's all you need to know. And which stocks are institutions dumping? And just like Friday, when everybody was running around with their hair on fire, oh, this is a crash, bond crash. No, it wasn't. It wasn't. Always remember, small mid caps tell you the truth, and yields always tell you the truth. That's who you look for the truth, and Phil's Gang. Thank you for listening. I'll see you on the charts, philsgang.com. Check us out, free for 10 days.